welcome to the deep dive. So the source material you sent in this time, it's a bit of a mouthful. We're looking at a structure called Digital Infrastructure.
Yeah.
ScSp SICAV-RAIF.
Yeah, that might be the most intimidating string of acronyms in modern finance. But look, we're not here to read a legal textbook.
Right.
Our mission today is to strip away that dense Luxembourg terminology and really show you why this very specific custom-engineered combination is the absolute go-to vehicle for big money. We're talking institutional capital that wants to ride this tidal wave of global data growth.
And that's the real hook, isn't it?
Yeah.
Why are pension funds, sovereign wealth funds, all these major players so obsessed with this exact structure right now?
Yeah, because the stuff it buys, the data centers, the fiber optic networks, the telecom towers, I mean, these are all fueled by megatrends you just can't escape. Cloud adoption is still ramping up. 5G is rolling out everywhere, and every single organization is more dependent on data than ever. These funds get that the assets are illiquid, you have to hold them for a long time, but they generate these incredibly stable, predictable cash flows.
So we're really looking at stability, not the usual tech volatility, it's almost infrastructure investing, but just for the digital world.
That's it, exactly. And those stability anchors are what pull in the long-term capital.
Yeah.
The assets are typically backed by long-term contracts. We're talking 10, 15, sometimes even 20-year leases.
Wow.
And they're with blue-chip tenants, rated operators. On top of that, the revenue clauses are often linked to inflation or volume, which gives these funds really predictable cash flow. And that kind of certainty, well, it's gold for an institutional investor trying to manage their liabilities.
Okay, let's get into that architecture itself. It really is like a triple layer cake designed in Luxembourg. Let's break down the three pieces, starting at the foundation, the ScSp. What is the special limited partnership actually doing here?
Okay, so the ScSp, the Special Limited Partnership, is that base layer. And it's critical because it's all about the relationship between the GP, the fund manager, and the LPs, the investors. Its main job is to be that familiar partnership wrapper that institutions, they know and expect from a private equity type of deal.
So it's basically the legal agreement that structures the economics.
It's the whole economic reality of the fund, yeah.
Yeah.
It spells out everything. Commitment periods, the distribution waterfall, the fees, and this is the key part, it lets the fund sponsor use that classic PE model of carried interest.
Or carry.
Exactly. The ScSp ensures the general partner is incentivized by getting a share of the profits once a certain performance hurdle is met.
And I'm guessing the tax side of the ScSp is pretty important too.
Oh, it's essential. The ScSp is designed to be tax transparent for Luxembourg income tax. So Luxembourg basically treats it like a conduit. The fund itself isn't taxed at that level. The profits just flow through to the investors, and then they get taxed in their home country.
Got it. Okay, that makes sense for the partnership deal. Now, the ScSp is then put inside the second layer, the SICAV, the investment company with variable capital. This sounds like the flexibility engine.
It absolutely is. Think of the SICAV as like a shared corporate shell. It's one single entity that acts like a holding company. And the magic of the SICAV is its ability to create compartments.
Compartments. So like running separate little businesses under the same corporate roof.
That is the perfect analogy. The SICAV is the building, and each compartment is a locked, separate office. The money and assets in Suite A, let's say that's for core fiber networks, are legally firewalled from the money and assets in Suite B, which might be for value-add edge data centers.
And why is that separation so crucial for these kinds of funds?
Because the digital infrastructure market moves so fast, a manager can raise one fund brand, the SICAV, but then launch multiple strategies or even different vintages over time without having to create a whole new legal entity from scratch every single time. One compartment can target stable assets, another can take on greenfield development risk, and the firewall protects the investors in one strategy from any failures in another. It's incredibly efficient.
Okay, so we have the tax-friendly partnership deal. The ScSp wrapped inside this flexible corporate shell, the SICAV. Now for the regulatory part, the RAI, the Reserve Alternative Investment Fund. I would have thought getting regulatory approval is always slow and painful.
It usually is, but the RAIF regime was specifically designed to fix that problem. It's kind of like the fast pass for Luxembourg funds. The key thing to know is that it's reserved strictly for professional and well-informed investors.
Which means?
Means you have to commit at least 125,000 euros or be a certified expert.
And how does that restriction allow it to be so fast?
Because the regulator, the CSSF, gives it a huge streamlining benefit. The RAIF itself is not directly authorized by the CSSF before it launches a new compartment. Instead, the fund just has to appoint an external, already authorized alternative investment fund manager, an AIFM.
So the supervision isn't gone, it's just shifted.
Precisely. The fund gets the indirect supervision of the CSSF through the AIFM. The manager's authorization ensures it all complies with the strict AIFMD rules, but the big win is it slashes the time to market. You can launch a new compartment in a few weeks instead of many months.
Which is a massive competitive edge in a space like digital infrastructure.
A huge edge.
So, to put it all together, you get the partnership economics from the ScSp, the strategic flexibility from the SICAV, and the regulatory speed and EU-wide marketing passport from the RAIF. That is a very, very engineered product.
It is. It's completely optimized for institutional scale and speed.
Okay, so with the structure set up, let's pivot to what the money is actually buying. What's in a typical portfolio?
We're talking about the entire mission-critical connectivity stack. So the core assets would be things like the long-haul backbone fiber networks and the metro fiber that connects major points in a city. And then, of course, the last-mile stuff, fiber-to-the-home rollouts.
And on the storage side, the data centers themselves. Are these the giant hyperscale ones or more specialized facilities?
It's both, really. You see investments in those huge wholesale data centers that serve the tech giants, but also increasingly in more specialized facilities like colocation centers and edge computing sites.
Edge is really interesting.
It is, because it's all about servicing applications that need low latency. Things like autonomous vehicles or localized content. That's essential for 5G.
And speaking of 5G, we can't forget the mobile infrastructure that makes it all work.
Absolutely not. Telecom towers are a classic staple here. I mean, that's the ultimate long contract, stable asset. But you also see investments in distributed antenna systems, neutral host infrastructure, all the things you need for those small cell deployments in dense urban areas, and, of course, the massive subsea cables that link continents.
I get that the assets are stable because of the long contracts. But at the end of the day, these are tech assets. Doesn't the strategy have to deal with the risk of technology just becoming obsolete?
And that's the core challenge, yeah. It's why the strategies range from pure brownfield to value add.
Okay, what's the difference?
Brownfield assets are your fully stabilized occupied data centers or towers. They offer really high, predictable cash flows with lower risk. Value-add projects, on the other hand, involve building out new capacity, which is higher risk but gives you that exposure to the growth premium.
So managers have to find the right blend of contracted cash flow and growth potential.
Uh-huh.
And what about on the financial side? These funds are using leverage, right? How high are the return targets?
Yeah, leverage is standard practice, but it's applied pretty prudently at the asset or compartment level, just to enhance the equity returns. Given the stability of the cash flows, managers are typically targeting net IRR's internal rates of return in the high single digits, maybe tipping into the low double digits depending on the geography, the debt level, and the mix of value-add projects.
And where does the actual cash come from? Is it just rent checks?
It's more diverse than that, which adds to the resilience. You've got your recurring revenue from leases, sure, but you also have usage-based charges, especially with data centers, linked to things like bandwidth or power consumption. And then for the value-add piece, you have development gains when you successfully build a new asset, followed by capital gains when the fund eventually sells or rotates those assets.
Let's shift the focus now to the people involved. We know it's a RAIF, so the investor pool is exclusive. Who are the big institutional clients really driving the demand for this?
The client base is strictly institutional, so you're thinking global pension funds that need to match their long-term liabilities, major insurance companies, sovereign wealth funds. We also see a lot of sophisticated family offices using these as part of an inflation hedging strategy.
And with that much capital locked in for 10 to 15 years, the governance structure has to be airtight. Who's making sure all the checks and balances are in place?
This is where the specialized structure really proves its worth. You have the general partner managing the fund, of course, but that AIFM is so critical. They are the authorized manager responsible for all the portfolio management, the risk management, and the mountain of regulatory reporting required under AIFMD.
What about external oversight? Roles like the depositary and the central administration agent, they sound a bit bureaucratic.
They might sound it, but they are absolutely essential. The depositary is the asset watchdog. Their job is to safekeep the assets, oversee transactions, and monitor all the cash flow. They make sure the money is coming in correctly and being distributed exactly according to the partnership agreement.
And the central admin agent.
They do all the heavy lifting on the fund admin side. They calculate the net asset value, or NAV, maintain the investor register, and handle all the reporting to the LPs and the regulators. This whole ecosystem gives the institutional client multiple layers of oversight.
You mentioned the long duration, 10 to 15 years.
Yeah.
What does liquidity look like for an investor over that time? Is there any?
It's very illiquid. It's a closed-ended fund, so LPs commit their capital for the whole ride. The only real chance for liquidity comes from secondary transfers, which is basically selling your stake to another qualified investor. And even that is always subject to the general partner's consent. This is truly patient, long-term capital.
Okay, so let's zoom out. For a huge institutional portfolio, where does an asset class like digital infrastructure actually fit?
It sits in a very strategic defensive spot. It's somewhere between, say, core real estate with the stability of physical assets and traditional regulated infrastructure like a utility or a toll road. It complements those by offering defensive traits. I mean, digital services are essential now, right?
Go on cyclical, you're right.
Exactly. But it also gives you exposure to this rapid structural growth that's being driven by digitalization. And that diversification, that low correlation with volatile stocks and bonds, that's the holy grail for a pension plan manager.
Let's talk about the tax environment in Luxembourg that makes this whole thing so attractive. You mentioned the tax-transparent ScSp, but what about the RAIF level?
So the RAIF itself offers a huge benefit. It's generally exempt from corporate income tax and net wealth tax on its investment income and capital gains.
How is that possible?
It's a deliberate part of Luxembourg's strategy to attract this kind of institutional capital. Now, while it's exempt from those big taxes, it does have to pay a very small annual subscription tax, usually just 0.01% of its net asset value.
It's tiny.
It is. So you get this incredibly efficient dual status, the transparency of the ScSp, so investors deal with tax at their own level, combined with the exemption status of the RAIF, which minimizes tax friction at the fund level.
Okay, let's shift to maybe the trickiest part of this, ESG, specifically energy use. We all know data centers are, well, they're incredibly power hungry. How do managers square that with sustainability goals?
This is a massive focus for LPs now. ESG integration is just non-negotiable, so managers have to be actively focused on the PUE, the power usage effectiveness of their data centers. They're looking for facilities with low PUE metrics, and just as important, a clear plan to source renewable energy.
Are we talking about just buying carbon offsets, or is it more direct than that?
It's becoming much more proactive. We're seeing them enter into direct power purchase agreements, PPAs, to guarantee a supply of clean energy for their assets. And beyond that, the climate resilience of the sites themselves, protection against flooding, extreme heat, that's a big part of the E in ESG.
And on the social and governance side, the S&G.
The social side often involves ensuring digital inclusion, so making sure connectivity reaches underserved communities. The G is about robust governance, which we've talked about, but also about diversity within the manager's firm and transparent reporting. And crucially, managers are now classifying their compartments under the EU's Sustainable Finance Disclosure Regulation framework.
What does that classification Article 6, 8, or 9 actually tell an investor?
It basically sets the bar for their sustainability ambition. Article 6 is just baseline disclosure. Article 8 means the fund has to actively promote environmental or social characteristics. But Article 9, that's the highest standard. That designates the fund as having a specific sustainable investment as its core objective. And LPs are pushing harder and harder for Article 8 and 9 products.
We have really broken this down. The acronyms, the assets, the economics. Let's bring it all back together for the listener. What is the ultimate value proposition of this whole structure?
At its core, it's about the perfect alignment of purpose. First, you get the credibility of Luxembourg as a world-leading fund hub.
Then you get those familiar partnership economics, the carried interest incentive, all thanks to that tax-transparent ScSp.
You also get the amazing operational flexibility of the SICAV, which lets you run multiple distinct strategies under one scalable brand.
And you get that essential regulatory fast track, the RAIF, which delivers the AIFM passport for EU marketing and gets you to market so much faster.
Which brings us to our final provocative thought for you to chew on. These structures are built for 10 to 15-year cycles. They rely on long-term contracts tied to today's technology 5G, the current cloud infrastructure. But the pace of innovation means that key technology standards, like the jump from 5G to 6G or fundamental shifts in how the cloud works, that could happen multiple times within the life of one of these funds.
So the stability that's promised by that long contract, is in this constant battle with the risk of technological obsolescence.
Exactly. So how does a general partner structure their exit strategy, the sale of these assets in a decade, when the very definition of what counts as a core asset could be radically different 5 years from now? That fundamental tension between long-term stability and rapid technological risk is the challenge that's built right into the DNA of every single digital infrastructure fund.
The ultimate balancing act. A truly fascinating deep dive into a structure that's really built for the future of data. Thank you for sharing these sources with us.
It was a pleasure digging into the complexity.
We'll catch you next time for the deep dive.